Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Monday, April 28th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what does a W-shaped market in a U-shaped economy mean? Our answers are early evidence from Bloomberg's tracking of shipping data supports warnings from Walmart and Target last week that U.S. shoppers will face empty shelves and higher prices. Since the U.S. hiked tariffs on China to 145% in early April, cargo shipments from China to the U.S. have plummeted by an estimated 60%. Ships currently docked in China that are headed to the U.S. are down roughly 40%. A developing stagflation has the S&P 500 on pace for its worst first 100 days performance under any U.S. president since Gerald Ford in 1974, as voter dissatisfaction with Trump's economic stewardship intensifies. This comes amid Fox News polling that indicated Trump's low 38% approval rating on the economy and even lower 33% approval rating on inflation. President Trump's glaring sensitivity to being blamed for economic hardship is supportive of our core thesis that the bond market robbed him of the fortitude required to bully the world into paradigm B on April 9th. Investors should continue to expect positive news on the trade negotiation front sans China and a concerted effort by the administration to highlight progress on the extension and expansion of the TCJA, aka the Trump tax cuts, and deregulation. Much of this good news has been priced in, however, and that is why we continue to anticipate a W-shaped market in a U-shaped economy. Right now, the market is expecting things to go well on the trade deal negotiation front. Once the growth slowdown becomes obvious in the hard data, the market will need to know things are going well, and it will demand policy support. The time and space between needing to know and demanding policy support and the uncertainty regarding taxes, trade, and the timing of Fed easing will likely create another round of selling pressure in the coming months. Transition to our 42 macro dashboard. As always, a wrap up with a question from our community. This one's titled Doge Savings from 1 trillion to 150 billion. It says, hi, DD. Thanks for another epic alt around the horn presentation. I'll definitely save this one for posterity. Elon Musk just lowered his Doge savings target to 150 billion. Add this to the Senate budget instructions that just passed, and you'll have a toxic cocktail to swallow. Are you changing your Doge savings forecast for now? I presume that this will have wild repercussions in the bond market. So excellent question. I think it's a really important topic to get to the bottom of, because recall that you go back to last fall when our friend Elon had the chainsaw on stage. His original target for Doge budget cuts was about $2 trillion taken out of annual federal expenditures. We called BS on that and essentially said there's no way they're going to get past 500 billion to a trillion. Elon Musk came out on in March, a couple of times in March, and actually reiterated that, or took their 2 trillion target down to 1 trillion, and reiterated that a couple of times in March. And so we thought our original target, which was back from December, ultimately got proven by Mr. Musk and his team over at Doge in March. Subsequently, we've seen him sort of, I wouldn't say necessarily fully walk that back, because there's still a decent amount of speculation as to what he meant in that cabinet meeting when he said we were targeting 160 billion for 150 billion for FY 2026 expenditures. Now, again, FY 2026 starts in October 1st. And it goes through September 30th of 2026. So he could have been sort of looking ahead in terms of the forecast of what they were expecting to hit the tape in that particular fiscal year, and ignoring fiscal 2025, which ends this September 30th. The problem is when you go to the Doge website, we're 3 months into this now, at least officially, more than 3 months into this now. You're talking about only $160 billion of savings thus far. It's not very unlikely. It doesn't appear that they're on a track to get to anywhere near $1 trillion. And if that's the case, then I think we have to ask ourselves as investors and citizens, both domestically and globally, but was Doge, kabuki theater? We called it out as potentially being kabuki theater last fall, when we said, this could just be a political theater designed to distract the American public, which is a very gullible American public, apparently, from, the multi-trillion dollar, debt finance tax cut program. We're talking about, another $5+ trillion of debt finance tax cuts. And it's our belief that based on the revenue we're likely to see from tariffs, recall that we still smooth-hauling tariffed ourselves already, irrespective of the reciprocal tariff trade punt, 90-day punt. the tariffs that we are already currently left with we're currently experiencing as consumers and businesses are still on the level of smooth Hawley. And so the administration is going to be collecting tariff revenue, and I do believe that they're going to use that to strong arm fiscal hawks in Congress into accepting an even lower expenditure reduction target. Recall that in the handshake agreement between the Senate and the House, maybe it was last week or 2 weeks ago, they essentially got that down for the spending cuts from 2 trillion to 1.5 trillion. We think you should take the under on 1.5 trillion. We're expecting it to not be much more than if it even is at 1.0 trillion, 1 trillion in terms of the spending cuts. So all in all, you're talking about more than take the over on $5 trillion in tax cuts, take the under on 1.5 trillion in spending cuts, probably settling somewhere close to $1 trillion if we have to, once it's all factored in, when you factor in the tariff revenue. It's our belief that, the fiscal retrenchment that the administration came in celebrating and really campaigned on, I think they're going to wind up having, lied to the American public about this. And this is not a political statement. We've been saying for years, both parties are addicted to fiscal monetary largesse. The reason we are, careening towards a fiscal crisis here in this country is because both the Democrats and the Republicans are addicted to debt finance tax cuts and debt finance spending. Debt finance tax cuts, debt finance spending, they both wind up with more debt on the public sector balance sheet that your kids and my kids and our kids have to pay for it. Or otherwise, we're going to might have to even go to war to protect our exorbitant privilege as the rest of the world starts to look around and say, okay, maybe we don't want to capitalize a 11% twin deficit economy at these types of interest rates or this level of equity cost of capital. And so I still think the long-term capital outflow story is going to be intact as a function of our inability to promote austerity, both at the nationwide level, but also at the household and corporate sector. And ultimately, you're probably going to talk about a lot less U.S. economic exceptionalism in the coming years as a function of that. And if that is true, then you're probably going to have a reversal at the margins, not the whole thing, but at the margins of capital flows that favor, rest of world assets like gold, assets like Bitcoin. And those are obviously things that we feature in our KISS portfolio construction process. So we'll wrap it up there. Excellent question. Really important topic. Oh, one final thing I'll say is if in our initial analysis, when we talked about Doge, if we said if they get to 500 billion to $1 trillion in expenditure reductions, you're talking about a 40 to 50 basis point increase. 30 to 60 basis point increase, depending on what side of that spectrum you wind up on in the unemployment rate. Now, if there's only going to be 150 billion, 160 billion, or whatever, winds up being somewhere kind of on the low, $1 to $200 billion range of expenditure reductions, you're talking about only a 10, 20 basis point increase in the unemployment rate, if at all. So that's positive for the economy, but it's ultimately bearish for the dollar and potentially bearish for U.S. asset valuations. Our valuation premium that we've earned as a function of our exceptionalism. You could potentially see some less foreign participation in our bond market as a function of our fiscal profligacy that continues to be championed by both parties. So we'll wrap it up there. Darius Dell here presenting our macro minute for Monday, April 28th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.